Folks, you are not going to believe how cleanly the tape has set the board for the week ahead. Last week, the market danced through tariff noise, energy shocks, and policy chatter, yet the VIX refused to break out of its moderate range. That tells me one thing loud and clear. The smart money has already priced in most of the headlines and is now waiting for fresh catalysts. This is exactly the environment where disciplined short premium strategies shine because the fear is present but not panicked. The volatility surface is telling us patience will be rewarded. This episode is brought to you by Iron Condor Command, the definitive guide that has helped thousands of traders master defined risk strategies with confidence. Here is the thing. While the pundits were screaming about trade wars and central bank surprises, the actual capital flows showed something far more interesting. Gold climbed steadily through the week, even as the dollar showed notable strength. Crude oil firmed heading into the weekend after a sharp move midweek. Bitcoin held firm, and the broader equity tape refused to roll over. You and I know what really happened here. The market absorbed geopolitical tension without breaking stride. That is not the behavior of a fragile setup. That is the behavior of a market that has already discounted the noise. Now listen, Saturday I walked you through how those same geopolitical threads had tightened the volatility premium without pushing the VIX into full panic mode. I told you the term structure was our best friend, and that VixShield's layered protection would keep us on the right side of any surprise. Well, the week played out almost exactly as the tape had whispered. 5 clean place signals, 0 hold signals. The system stayed in rhythm. But that was last week. Today we turn our eyes forward, because the week ahead carries its own set of tests, and our job is to be ready before the opening bell on Monday. Let me paint the picture for you. We head into Monday with the S&P 500 having held its ground through a week that included fresh tariff announcements out of Washington, escalating rhetoric around Taiwan's Strait patrols, and a surprise OPEC production cut that sent crude oil higher in a hurry. What the mainstream headlines called a trade war escalation, the bond market treated as largely priced in. 10-year yields barely budged. The dollar index ended the week only modestly changed after swinging between 98.48 on Monday and 98.92 midweek before settling back near 98.21. Here is what they are not telling you on the financial networks. Capital did not run for the hills. It rotated. Gold climbed from $4,675 on Monday all the way through a dip midweek before closing near $4,630 on Friday. That move in gold, while the dollar strengthened, tells me real money is still hedging geopolitical risk the old-fashioned way. Meanwhile, crude oil jumped from $96.37 to over $100 by Wednesday, before giving back some ground to close near $101.94. Energy policy is back in the driver's seat, and that directly affects how volatility behaves in the equity pits. You and I know this. When crude moves that fast, the cross-asset correlations tighten. Transportation stocks feel it. Manufacturing costs feel it, and the VIX starts to price in the possibility of margin compression. Yet our Iron Condor framework does not care about the narrative. It only cares about where the expected daily range sits relative to our strikes. That is why the VixShield system stayed disciplined all week. 5 place signals executed between 3:10 and 3:14 in the afternoon Central Time, each one independent, each one expiring the next market day. No carryover, no emotion, just clean, defined risk setups that either collected full credit or hit a defined loss and moved on. This setup matters for the week ahead because the geopolitical backdrop has not cleared. We still have BRICS nations signaling new trade settlement mechanisms that bypass the dollar in certain corridors. We still have sanctions chatter aimed at key energy producers. And we still have domestic policy debates around immigration and labor markets that will show up in the employment data later this week. All of this flows directly into volatility pricing. The conservative truth-seeking lens says do not listen to the panic peddlers. Watch what the tape actually does. Last week, the tape said the fear was contained. Will it say the same thing this week? That is the question we are prepared to answer with rules, not opinions. Let me say it 3 times so it sinks in. The market absorbed the tariff headlines. The market absorbed the energy shock. The market looked at the strongest dollar move in days and still refused to crack. That is resilience. That is what disciplined capital preservation looks like in real time. And that is why our iron condor positioning remains focused on harvesting theta rather than guessing direction. Now, this is where it gets interesting. While the equity tape looked relatively calm, the volatility term structure was sending a subtle message. The VIX held in the high teens most of the week. That level by itself is not scary. What matters is how the curve is shaped. When near-term volatility sits below longer-dated volatility, we are in contango. That is the calm, normal state that favors short premium trades like ours. Last week, that contango remained intact, even as crude oil spiked and gold climbed. The twist is that any break higher in the VIX could quickly flip that relationship and tighten our expected daily range filter. Ask yourself, when was the last time you saw geopolitical risk this widely discussed, yet the VIX refused to spike above 20? It happened this week. And smart money noticed. They kept selling premium on the dips. They kept the dollar bid. They let gold do its safe haven dance without panicking the equity market. That tells me the institutional crowd has already positioned for the next round of headlines. Our job is to stay inside that positioning with defined risk structures that do not care if the headline is bullish or bearish. Only the math matters. Here is the thing about the week ahead. We have a relatively light economic calendar on paper, but the implications are heavy. Monday kicks off with the usual global PMI readings and a chance for fresh commentary from European central bankers. Nothing earth-shattering, but any shift in tone around rate cuts could ripple into the dollar and therefore into our volatility surface. Tuesday brings us the real focus. We get ISM services data and a chance to see whether the labor market is still tight or starting to crack under higher rates and immigration policy changes. You and I know how these reports get spun. The mainstream will call any softening a reason to celebrate. The tape may say something different if it shows up alongside higher energy costs. Wednesday is Fed Day in all but name. We get the latest FOMC minutes from the prior meeting. Markets will parse every word for clues about whether the Fed is truly on hold or if geopolitical energy shocks are forcing their hand. Remember what I told you on Saturday. When the Fed talks, the VIX listens first, then the dollar, then equities. If those minutes show any hint of concern about inflation coming through the crude channel, we could see the term structure steepen in a hurry. That directly affects how wide we can safely place our iron condor wings. Thursday brings initial jobless claims and continuing claims. These are the canary in the coal mine for labor market health. With immigration policy still a hot button, the numbers will carry extra weight. A surprise drop in claims would be hailed as strength. But if higher energy prices are starting to filter through to business costs, those claims could tick higher. Either way, we will be watching the reaction in real time because it feeds straight into Friday's bigger number. And Friday, of course, is the employment situation report, non-farm payrolls, unemployment rate, average hourly earnings. This is the one that can move markets for days. The conservative lens says we should not try to predict the number. We should prepare for any outcome. That is why our VIX risk scaling rules exist. If the VIX pushes above certain thresholds before the report, We simply dial back to the conservative tier or sit on the sideline entirely. Capital preservation first, always. Let me restate that three different ways. The economic calendar looks light, but it is loaded with second-order effects. The calendar looks routine, but geopolitics makes it anything but. The calendar looks boring until you realize energy policy, trade policy, and labor policy are all colliding at once. That collision is what we are built to handle with defined risk, iron condors placed every single day between 3:10 and 3:14 Central Time. So how do we turn all of this into a practical game plan? We start with the RSAI engine and the expected daily range. On Friday, the system gave us clean place signals across the conservative, balanced, and aggressive tiers. For those trades to expire worthless this week, the S&P 500 needs to stay inside the wings we sold. That is not a prediction. That is simply the math of our defined risk setup. If the employment report on Friday causes a gap move, we will already be flat from the prior day's trade and ready to assess fresh conditions on Monday. This is the beauty of the VixShield approach. Every trade is independent. Monday's Iron Condor expires Tuesday. Tuesday's expires Wednesday. There is no overlap. No hope that Theta will save a loser from 3 days ago. That discipline is what separates stewards from speculators. And right now, the geopolitical environment is testing everyone's discipline. We have sanctions tightening around certain energy routes. We have China tensions that keep defense stocks in play. We have BRICS chatter that challenges dollar dominance, yet the dollar index still closed the week near 98.21. The tape is not buying the panic. The tape is telling us the moves have been anticipated. That gives us confidence to stay mechanical. If the VIX stays in the high teens, our full menu of strikes remains available. If it pushes toward 20, we automatically restrict to conservative and balanced only. If it clears 20, we go to hold and let the ALVH hedge do its job. Those are not suggestions. Those are hard rules forged from decades of observing how volatility behaves when policy and geopolitics collide. The resolution of last week's setup is simple. The market absorbed the shocks. The VIX stayed contained. Our signals fired cleanly. Now we take that momentum into a week that looks quiet on the surface, but carries real risk underneath. Our job is to remain patient, mechanical, and fully hedged. Pull back with me for a moment. What we are really watching this week is the intersection of five distinct geopolitical threads and how they affect capital flows. First, the tariff and trade war rhetoric. Every time Washington floats new duties on Chinese goods, the immediate headline screams escalation. But the bond market has been pricing these moves for weeks. The real question is whether fresh tariffs force the Fed to keep rates higher for longer. That would support the dollar and keep volatility suppressed. We saw that exact dynamic play out last week. Second, we have the energy angle. OPEC surprised the market with production cuts that drove crude from $96.37 to over $100 in just 2 sessions. That is real inflation risk flowing through the system. Higher energy costs hit corporate margins. They hit consumer spending. They show up in the PCE and CPI numbers later this month. The conservative truth-seeking view is that energy policy is monetary policy, by another name. When crude moves that sharply, the VIX term structure listens. Our ALVH hedge is specifically built to monetize those expansions in volatility without distorting our core iron condor edge. Third, the China-Taiwan situation remains a slow burn. Increased patrols in the strait create headline risk, but so far capital has treated it as noise rather than signal. Still, any escalation would send gold higher and push defensive sectors to outperform. We saw gold climb from 4,675 to 4,630 despite a stronger dollar. That move is worth watching closely because it shows real money is not fully convinced the risk is gone. Fourth, we have the domestic policy mix. Immigration reform debates and labor market tightening show up in the employment report on Friday. Tighter labor means higher wages, which can feed inflation, which keeps the Fed on hold. The pundits will call any strong number bullish for stocks. The tape may say it is bullish for volatility because it removes the chance of near-term rate cuts. Our system does not take sides. It simply adjusts strike width based on the expected daily range. Fifth, and perhaps most underappreciated, is the BRICS push for alternative settlement systems. Every time they announce a new bilateral trade deal that avoids the dollar, it chips away at long-term demand for treasuries. That should push yields higher and the dollar lower. Yet the dollar index finished the week little changed. Once again, the tape is telling a different story than the narrative. The market has been digesting these shifts for months. What looks like new news to CNBC is often already reflected in positioning. This bigger picture matters to your iron condor because every one of these threads affects the volatility premium we harvest. When geopolitics collides with policy, the VIX can gap. Our ALVH layered VIX call structure is there to absorb that gap and turn it into a hedge that pays for itself over time. 35 to 40% reduction in drawdowns at an annual cost of only 1 to 2%. That is not speculation. That is engineering. And it lets us stay in the game when others are forced to the sidelines. The conservative lens demands we question the mainstream story. They said trade wars would crash the market. The tape said otherwise. They said energy shocks would spike volatility to new highs. The tape kept the VIX in the high teens. They said labor data would be the catalyst for a breakout. We will see what the tape says this Friday. Until then, we prepare with rules, not hope. Let us talk about how the VixShield strategy is positioned for the week ahead. On Friday, the RSI engine delivered clean place signals for all three risk tiers. The conservative tier targeted a credit around 0.70 with wider wings tied to the expected daily range. The balanced tier looked for roughly 1.15, and the aggressive tier targeted closer to 1.60. These are not arbitrary numbers. They are derived from real-time skew, volume-weighted average price, and momentum in the volatility surface. For these positions to deliver full credit, the S&P 500 must close this week between the short strikes we sold on Friday. That range is deliberately set outside the expected daily move so that normal market action leaves the Condor untouched. If we get a headline surprise on Wednesday from the Fed minutes or on Friday from the jobs report, we simply take the outcome of that day's independent trade and reset fresh on Monday. No rolling, no praying, no adding capital. That is the discipline that has delivered consistent results across different regimes. The EDR indicator is our mechanical filter. When the expected daily range rises above 0.94% or the VIX clears 16, we trigger the theta time shift protocol. That rolls the threatened condor forward in time to capture more premium once volatility normalizes. It is not a martingale that doubles size. It is a temporal shift that uses time instead of capital to recover. Back-tested recovery rates on these shifts sit near 88% without ever violating our 10% maximum account risk rule. The ALVH hedge remains fully deployed across all regimes. 4 short-dated VIX calls, 4 medium-term, 2 long-dated. That 4-4-2 structure has proven it can cut maximum drawdowns by 35 to 40% while costing only 1 to 2% per year. In an environment where crude oil can jump $10 in 2 days, that hedge is not optional. It is the second engine that keeps the plane flying when the first one encounters turbulence. VIX trend rules are also in force. With the spot VIX in the high teens, all 3 tiers are live. Should it break above 20, We restrict to conservative and balanced only. Above a higher threshold, we move to full hold and let the hedge work. These are not guidelines. They are non-negotiable risk scaling parameters designed to keep emotion out of the process. This scorecard is not about bragging. It is about transparency. 5 place signals last week. 0 hold. The system worked exactly as designed. The week ahead will test us again, but the framework is built for exactly these moments. Geopolitical noise, policy uncertainty, commodity spikes. All of it gets channeled into defined risk setups that expire the next day. Your portfolio does not have to live with overnight gaps or assignment risk because we use cash-settled European-style SPX options exclusively. That structural edge matters more than ever in a world this noisy. Tomorrow morning when the markets open, I will be watching 3 things above all else. First, the reaction in crude oil after its strong move last week. If it holds above $100, the inflation narrative stays alive, and our volatility surface will reflect that. Second, any fresh headlines out of the Taiwan Strait or new BRICS announcements. Those can move gold and the dollar in ways that affect equity volatility indirectly. Third and most important, the opening price action relative to Friday's closing range. That tells us whether the smart money is pressing the recent highs or taking some chips off the table ahead of the Fed minutes and jobs report. The game plan is straightforward. We wait for the 3:10 to 3:14 window Central Time. We let the RSI engine scan the live skew and expected daily range. We place the appropriate tier based on where the VIX sits. We collect our credit. We let the position expire the next day. Win or lose, we move on with 0 emotional attachment. That is how you survive weeks like this one. That is how you compound over time. If the economic data comes in mixed, we may see the VIX term structure flatten or even invert temporarily. That would tighten our strike selection and favor the conservative wing. If the data is benign and the geopolitical rhetoric cools, we may see contango steepen, which widens the profitable range for all 3 tiers. Either way, the system adapts mechanically. You do not have to guess. You only have to follow the rules, and be sure to listen for any breaking news from Miss Vicky. If you found this summary valuable, consider upgrading to Pro or higher for the full twice-daily VixShield market summaries, proprietary signals, and private RSS feed. Visit VixShield.com to learn more. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution. Signals only. Past performance is not indicative of future results. This is VixShield, your protection against market uncertainty.